Okay, so just want to remind everyone that you are being recorded, or we all are being recorded. I hope you're seeing the recordings on our website. They've been a little slow through compliance lately, just like everybody else. Our staffing with the compliance support group has been a little slower and less staff than usual. So it's taking about a week to get videos up, but that'll all change in a couple of weeks, because what's happening with Attleboro Wealth Management right now is that we are in a transition to move our clients' accounts from Kestra and NFS and Fidelity. NFS and Fidelity are the same thing. NFS is a division of Fidelity to Charles Schwab. So we're excited about that custodial relationship. We've been approved by the SEC to have a standalone registered investment advisory firm. So nothing changes as far as Attleboro Wealth Management, except we'll be an RIA, registered investment advisor, and we'll custody our clients' assets with Charles Schwab. We're still maintaining a relationship with Fidelity, so we could potentially have some accounts there if needed, but not likely. So that's exciting. However, it's a tremendous amount of work. So for the next, I'd say the full month of February into March, we're going to be working on this and setting it up for our clients. So be patient with us. If you need something right away, please let us know. Don't hesitate, but give us a little bit of lead time. If you need money, we need to get that out to you quickly. Your scheduled transactions are already being worked on. If you have a monthly distribution, you'll be receiving January, February, and March, just so we're ahead of it. And if you have a quarterly distribution and your next quarterly distribution isn't until the end of March or April, we should be just fine by then. But if you have something pressing, you need it now, let us know, so we make sure that we can get you your money as quickly as possible. So you are all being recorded. There is a chat function at the bottom of the screen. I'm sorry, chat is disabled. There's a Q&A section at the bottom of the screen. So use that Q&A button if you have questions along the way. You're also muted. So let's get going on today's webinar. We're going to talk about the Slott updates for about 15 minutes. We're going to go over market updates and analyst reports for about another 15 minutes. And today's financial planning topic is why is life insurance so important to financial planning, or why is life insurance an important part of financial planning? And we'll spend some time with that. So coming up, we have, for our March 16th at 6:30 special webinar, we have Sarah Brenner from the Ed Slott group joining us. Sarah is one of my go-to folks with all the tough questions that come across. Sarah helps me out all the time, and we're going to talk about trusts as beneficiaries of IRAs, pros and cons, how it works, why you should do it, why maybe you don't, may not want to do it. We don't have February scheduled yet. I'm still talking to a couple people. I'm hoping that we can get something scheduled, but we just may not, and that's okay for February. But certainly we have March scheduled for a special webinar, and April 27th, we have David McKnight joining us live here in Newtown. You'll be getting an invitation. And if you're one of you special folks who's often on the webinar, who follows us on a weekly basis, who get these invites, you're going to be invited to a VIP event with David. And we'll have some books and conversation and some snacks, things like that. So that'll be great. That's April 27th. That's a Wednesday at 6:30. It looks like it's about 99% that's going to be at the Newtown Theater, which is a really, really neat venue. We're working on some sound issues, but I think we've got it figured out. So more details to come on that. And we do have some classes coming up. So I didn't mention this before, and I have to add that to my notes. The Changing World of Retirement classes. The first class of the year starts, I'm just looking at my menu or my calendar. If you see me looking over here, it starts March 3rd. So how these run are 2 Thursday evenings, 2 Tuesday evenings. This is a webinar again. I was considering doing it at Holy Family College or LaSalle, as I've done in the past here locally in Newtown. We also did Rider University and another one over there that I couldn't recall off the top of my head. And of course, Montgomery County Community College we've done, and Del Val and Doylestown. But this one's going to be webinar. I just I want everybody to feel comfortable and be able to attend who wants to attend without the concern. I don't know what it's going to look like in March. It seems everything Corona or COVID seems to be waning again, but who the heck knows, right? So this is going to be a webinar, 2 Thursday evenings, the 3rd and the, let's see what that looks like, the 3rd and the 10th, and then 2 Tuesday evenings, the 8th and the 15th. So I hope you can join us with those. And if you want to, you're going to get an invitation via email. And if you want to share that with any of your friends and loved ones, you're welcome to. Okay. So now let's talk about our Slott report. This was kind of fun. And this came from Andy Ives. I'm assuming that everybody can see me okay, or hear me okay, because someone would have said something by now. But Andy Ives wrote this bit. It's kind of a Q&A or a trivia, 5 Q&As about rollovers. So he writes about the Martin scenario. Martin, age 40, has never done an IRA rollover before. He took a distribution from his traditional IRA in December of 2021. Now, let me give you a backstory before I continue. This is information that comes in. We get questions, and I've got this bizarre situation. I get questions by attorneys and CPAs and clients and folks who just find me because of the Slott website. So we get these crazy questions that people do with their IRAs. And listen, IRAs are confusing. I hear this all the time from people. They mix things up. Well, I'm going to wait until I'm 72 to take my Social Security because that's when the IRS says I have to. Well, no, there are the required minimum distribution rules, right? You have to wait until you're 72. I kid you not. I hear these things because it's confusing. I'll wait until I'm 70 and a half. I'll wait till I'm 72. I have to wait until I'm retired to take my Social Security. That's not true. I have to wait, I have to wait until I'm 72 or 70 and a half to take IRA distributions. That's not true. So all kinds of rules and 59 and a half and 70 and a half and 72 and 62 and 66 and they're all confusing. So people tend to blend them together and come up with their own ideas about what the rules are. And sometimes that can cause problems for not understanding. So here's Martin's situation. He's 40 years old. He's never done an IRA rollover before. He took a distribution from his traditional IRA in December of 2021 for $10,000 and put it in his bank account, his checking account. Then Martin just last month took another distribution from his IRA for $50,000 and also put that into his checking account. So then Martin's question was, what can I do with this? I heard there's a 60-day rollover rule and you could borrow, people say, well, you could borrow your own IRA money and do whatever you want with it and put it back within 60 days. And that's not necessarily true. You have to be very careful. So the first trivia question, Andy writes, is, does the fact that Martin commingled both IRA distributions into his checking account present any problems for future rollover? So because he did $10,000 in 2021 and another $50,000 in 2022, December 2021 and January 2022, so a month apart, let's just say, or within that 30 days or so, does that pose a problem? The answer is it does not. There are no rules that stopping a person from combining an IRA distribution with other accounts or using the money while it's out on rollover for 60 days. It's out of the IRA in that rollover status. So no problem with combining them. Can Martin roll over both the $10,000 and the $50,000 distribution? The answer is no, he cannot. That would violate the 1 rollover per year rule. Now that's still relatively recent. I would say in the last 5 or 6 years that came about. That was a tax court decision that said you can't do this 60-day rollover more than 1 time per year. And it's its own year. It's not its calendar year. Also, he cannot consolidate the distribution and roll over one $60,000 amount. So he can't say, well, listen, I did both of these within 30 days, not to mention 60 days. Why can't I just now roll it over into an IRA? Because the 1 per year rule is based on the number of distributions, not the number of rollover deposits. So that's a really great point. It's not how many times you you commingle it, write one check from your checking account, put it into the IRA. It's how many distributions come out of the IRA. Question number 3, since the $10,000 distribution came first, is that the only distribution that can be rolled over? The answer is no. This is another common misconception. Since both distributions were taken within the previous 60 days, and I'll explain why it's so common in a second. Since both distributions were taken within the previous 60 days, Martin can choose which distribution gets rolled over. As long as he completes a rollover within 60 days, he can roll over any amount up to $50,000. Why is it only up to $50,000? Because he can't do both the 10 and the 50. He can do any portion of that, but he can't go over the 50. Question number 4. Oh, excuse me. Let me explain why that's so that's commonly confused. Because the way it really works typically is somebody, especially when you're talking about distributions, it can also get really messy when you're talking about rollovers and transfers. If someone said, all right, well, I'm going to take a rollover, a 60-day rollover in January, and now I found that I'm going to take this $50,000 out of my IRA and I'm going to put it into Vanguard. And then they liked the way that happened. So they took the other IRA money and they rolled that over. Say they had an account at Merrill Lynch and they didn't necessarily like what Merrill Lynch was doing. They had another IRA account for $500,000. And several months later, they said, I like the way that was done. I can do that 60-day rollover. Let me distribute that money into my checking account. I'm really not happy with what's going on there. I can sit there and while I'm looking for my opportunities. And you know what? I like this Vanguard, so I'm going to roll over that money into Vanguard. Anyway, so the problem is that violates the once per year rule. It's outside that 60-day window. The original amount roll over just fine. The second amount, the $500,000, is going to be counted as a taxable distribution. That stinks. So that's where that confusion comes along. All right, question number 4. If Martin elects to roll over the $50,000, is he stuck paying taxes and 10% early penalty withdrawal penalty on the $10,000 early distribution? Remember, Martin is only 40 years old. If you're under 59 and a half, you take a distribution. In most cases, there are some exceptions, but if you take a distribution from an IRA, you pay the tax plus a 10% excise penalty on that early withdrawal. Well, the answer is not necessarily. If Martin rolls over the $50,000 and no other exception applies, death, disability, I think I don't know if $50,000 would be covered for adoption, but there are some other exceptions. Then yes, taxes and the penalty on the remaining $10,000 will apply. However, if he was still within the 60 days, Martin could deposit the $10,000 into a Roth IRA. This will qualify as a valid Roth conversion. The taxes will still be due, but there is no 10% penalty on Roth conversion. Additionally, Roth conversions do not count against the 1 year per year rule, one rollover per year rule, and can be done in an unlimited amount annually. Of course, Martin would have to qualify to be able to do, Martin wouldn't have to qualify to be able to do a Roth conversion. Anybody can do a Roth conversion, no matter, I was thinking contribution. Sorry about that. See, it happens to me sometimes too. You just make sure that I clarify. So Roth conversions do not count against the 1 rollover per year rule and can be done in an unlimited amount annually. That's right. You can do as much or as little as you'd like. Doesn't matter how much income you have. Does the fact that Martin took the $10,000 distribution in December and converted it to a Roth IRA in January present any problems? The answer is crossing calendar years with rollovers or conversions is perfectly acceptable. He goes into a long way to say it makes the paperwork more difficult because you have 2 tax years reporting. That's all. Andy wraps up with the Martin scenario is relatively basic, but the different pitfalls and possibilities for what happens after an IRA distribution are mind-numbing. Yes, they are. We talked about that. Be sure to know the rules and repercussions before executing any IRA transaction. Check to make sure it's something you can do. All right. Any questions about that Slott report before I move on? Okay, good. All right, let's talk about the markets. Everybody's paying attention to the markets. I don't even have my screen up yet. Let's see what's going on today. We're down a little bit today. Okay. So this may be how it is this year, folks, is that I gave you my thoughts early on. I think it's going to be a very modest year or down. There's going to be a lot of volatility in between, and you're going to find people trading. There's a lot of traders. It's easy to trade now. You can buy the entire S&P 500, the entire Dow Jones, an exchange traded fund. We'll have another discussion about what an exchange traded fund is, what a mutual fund is, what individual stocks, bonds, all that, like the basics. We'll do that soon. But people can get in and out of the markets pretty easily these days, and you're going to see a lot of that. I think you're going to see a lot of people kind of riding these waves. Now, that's not the best way to invest. My experience has told me that you want to set up your allocations as that work well for you. Give you your base, your timeline, your foundation. All those things, the account segmentation, principal protection, and asset allocation, are three pillars of investment. But and that generally works over time, and it makes sure that you have the money you need right now to pay for what you need right now. But there are people that believe the opposite of that, and they believe that buying into timing down markets, buying into the timing down markets and coming out in up markets. So when you see big swings like we were down significantly. We're up. I think we closed up 400 or 500 points yesterday in the major markets. You're going to see some volatility like this, and it's easy to set these things. There are computer programs that sell, or buy, given different things. So different triggers. So you're going to see more volatility. And here's what the volatility looks like so far this year. So as of the close on Friday, the S&P 500 was down 6.93% for the year, so almost 7%. The Dow Jones Industrial Average was down a little over 4%, 4.36%. The NASDAQ was down by the end of the week last week, down 12%. I think it was up 3% yesterday. It's down about a half a point right now. So, the bond markets, so the stock markets are down. Generally, all the indices I'm looking at are actually down, except for master limited partnerships. Bond markets are also down. High yield bonds are down. The U.S. Treasury, 2-year U.S. Treasury is down. The 5-year U.S. Treasury is down 1.6%. That means if you invested in an index that invested in the 5-year U.S. Treasury, you're probably down about 1.61%. So it's really, really challenging when the stock market's down and the bond market is down. The question is, where do you go for safety? That's why principal protection is important. You've got to offload that risk to a large organization, a bank, an insurance company, something like that. So your worst year is going to be zero. Asset allocation, of course, you have exposure to all these areas that we're talking about, global exposure, U.S. exposure, real estate, bonds, precious metals, all the things that you want in your portfolio in a balanced way. And then the account segmentation, I can't say enough about it. Having your money in the right parts of the timeline, your timeline, and making sure that times like this, when the markets are down, don't keep you up at night because you've got a significant amount of conservative funds for the first several years of your retirement time when you're going to need it. And then you move out on the line as you get more aggressive as you go. I was talking to somebody over the weekend, and they used a really great quote. I don't know if it was hers or not, but it has to do with acting too quickly and getting it. Sometimes people are very anxious about, we got to move, get into this, and we got to get going on this. And I talk about building a foundation. You've heard me talk numerous times about when I was in San Francisco, the buildings out there are built on foundations that allow the buildings to move slightly so that when there's an earthquake, the building may crack, but it won't be devastated and crumble down. That's how I think about our portfolios. We want to make sure we have the foundation of asset allocation, principal protection, account segmentation. And this person says, yes, but if you run through the concrete while you're setting it up, it makes the foundation less strong. And I thought, my goodness. She said, you're putting footprints in the concrete, and it affects the integrity of it. And I thought that is a really great visual, right? The visuals work well for me. And again, I don't know if she came up with it herself or something she read, but otherwise it's brilliant. It was my daughter, so I'll assume that it was her. And really, I wrote it down. I sent myself an email with it because we do get people, especially early on, who say, we got to go. Let's get this because this is happening in the markets. You can't respond to the market. You've got to set yourself up. You've got to give it time to get in position. You've got to, sometimes it takes, a few months or longer to get these things in. I often dollar cost average into markets. That could take 6 months to a year. You've got to be patient and give it time. You're doing this for the rest of your life, not just for today, 6 months or a year from now. Okay, let me get off my soapbox there. So here are some, so they're the markets. Here are some analyst reports. One, I've started including from time to time Wall Street Journal. I like the Intelligent Investor article in particular. And there are several, they wrote about several folks and their thoughts about the market. Now, Jeremy Grantham has been getting a lot of press, and Jeremy Grantham's been around a long time. He's co-founder of the asset management firm GMO, very well respected. GMO is kind of a bad word now. My wife would perk up if she heard me say GMO. Everything in our house is organic, non-GMO. But anyway, so GMO is a well-respected asset management firm, and Jeremy Grantham's been around a long time, well-respected. And he wrote, I'm going to read you what he wrote, and the quote was in the Wall Street Journal. He writes, we are in the fourth super bubble of the last 100 years. The final feature of the great super bubbles has been a sustained narrowing of the market and unique underperformance of speculative stocks, many of which fall as the blue chip market rises. This occurred in 1929, in 2000, and it is occurring now, he says. At the end of the great bubbles, it seems as if the confidence termites attack the most speculative and vulnerable first and work their way up, sometimes quite slowly, to the blue chips. When pessimism returns to the markets, we face the largest potential markdown of perceived wealth in U.S. history. So that's a doom and gloom statement from Jeremy Grantham. I don't know. I'd have to go back and look at his other writings and see if this is kind of where he is and if he just is a contrarian. And that's okay. There are plenty of people in this article who had thoughts opposite Jeremy Grantham's, but again, Jeremy Grantham is well respected, and I pay attention to what he says. It doesn't mean this is what's going to happen, but it does mean that we don't want to be overly optimistic about what's the markets looking back at what's happened over the last 3 years and thinking it's just going to go and go and go like that. We have to be realistic. We've got some significant headwinds ahead of us. One of them being inflation. Another one that ties directly to that being our staffing shortages throughout the country in it seems like every bit of industry. We have rising taxes on the horizon. We have increased debt. We have a lot coming at us. So that's a lot of headwind for our economy and of course our market. So you've got to set that foundation, get your things in order. All right, that's Jeremy Grantham, the Wall Street Journal. BlackRock. So whether you love or hate BlackRock, they're one of the most, the largest for sure, and I think most well-respected financial firms in the world. And they do have very good analysts and analyses. Not that I agree with them all the time. They write, so they do these key points, which I really like and is easy for me to share with you. Their reports are super long, but the key points are great. So they write, buying the dip. We stick with our modest equities overweight. So equities are stock. So they're modestly overweight stock, but are not buying the recent dip yet. So they think, BlackRock thinks there's more room to travel down. The main reason they're not buying yet, confusion over the supply-driven macro environment. So what the heck is happening with the supply out there? Really, that's what's holding them back. They're given a market backdrop. Stocks fell further as the Fed. We know that the Federal Reserve is talking about raising rates, a likely rate hike in March, and suggested it could front load rate hikes even more than previously indicated. There's all kinds of speculation out there. The Feds, I think they started at 3, they went to 4. Now, many people are saying 7, 8. So we're looking at, significant increases in interest rates. Don't forget, The 10-year treasury should historically be at about 5.5%. I think we're still at about 1.7 right now. So we've got a lot of room to go up. Then it talks about what's coming up this week ahead. U.S. jobs data this week will show Omicron's impact on the restart, but it's unlikely to dissuade the Fed from kicking off rate hikes in March. So what does that mean? We're going to see negative effects from what we just went through and what we're still going through with Omicron. But BlackRock thinks that it's not going to stop the Fed from moving off its path. Robert D. Lucia from Prudential. This was almost a repeat of a report a few weeks or maybe months ago. I don't remember. But he writes I actually had to look at this date a couple times because I felt like it was, maybe I picked up something that was a repeat. But he writes, is U.S. consumer inflation transitory? So the FDIC chair and the Fed chair said at the end of December that inflation is no longer transitory. So again, I don't know why he's still having this conversation, but it's his article. He can write what he wants. Just again, this is a multi-page. I think it's an 8-page article, but I pulled 2 bullet points out of it because he talks a lot about inflation, and I think he's got some good points. He writes, there is widespread misinformation and confusion with respect to inflation and its causes. Based upon current trends, the underlying rate of consumer inflation is approximately 5.5%. Now, we're at 7. The Bureau of Labor Statistics says 7. Sharp increase by 1.5% 1 year ago. Wages are increasing at an annual rate of 5. My forecast, so De Lucia's forecast, assumes that consumer inflation will accelerate beginning later this year and during all of 2023, rising to 5% in 2024. So he's saying that year-over-year inflation that we saw at the end of the year at 7%, beginning of January at 7%, is really 5.5 with some adjustments. He didn't go into what his adjustments are. Well, I'm not going to go into what his adjustments are. And wages are increasing at 5%. My forecast assumes, that he said, that this is going to continue all of 2022, all of 2023, and rising to 5% in 2024. Wage inflation is expected to remain elevated within a range of 5 to 6%. Boy, I hope he's wrong, but we have to plan for this because that's unsustainable for a lot of people. I will tell you, if we start having to put in 4%, 5% inflation in financial plans, many plans are going to fail. This is another reason why you have to review your financial plan every single year. I'll tell you that most people out there that do financial planning, take your word for it when you tell them how much you need to spend every month. And most people come to us and they say, you know, I'm just going to throw a number out there. I need to spend $10,000 a month. And then when we do the work, you go through the expense sheet and you write down, you know, or log in your expenses. It might come out to $12,000 a month. We might uncover things. Sometimes it's less, but I can't think of a time recently when it's been less. So it's not that you folks aren't being honest with us. It's that, you know, most people, even my engineers, I've got a lot of engineers in our firm. They're very detailed people who are clients in our firm. They're very detailed people, but even those folks come back and say, you know, I didn't think about that. And that's another $2,000 a month. And they're big dollars. So most planners take your word for it and they don't do the work for it to dig in like we do, and I wish other people did more of. Most planners out there are still working with very low inflation rates of 2.3%, sometimes 1% I've seen. You know, this is not good. You want to make sure you're lined up, but you don't want to get a false sense of security. So this is why you have to, first of all, make sure you're really fleshing these things out and make sure that you're being realistic and make sure you're using the right numbers. Riverfront, I tell you, I lost some faith in my friends at Riverfront today. They used one of my words, my what do you call it? Pet peeve words. So they were talking about recent market volatility, and Riverfront writes, we remain constructive on stocks, but watching price trends, inflation, and rates closely. If I have a lot of intelligent folks who follow us on this webinar. And I know one fellow is a PhD. He has a PhD in finance. And again, a lot of engineers and, there's a retired financial advisor out there. If anybody can tell me what the heck that means, constructive on stocks, I'd really like to know. It's almost like when I hear someone say irregardless. It really gets to me. I don't know what constructive on stocks means, except for you don't want to take a position. That's what it means to me. RiverSource is saying, we really don't want to take a position on this. We don't know what the heck's going to happen. We don't know which way it's going to go. They're right. Key takeaways include, we anticipate greater volatility in 2022 and are now seeing it. Well, no kidding. I mean, that's easy. In our view, the volatility is linked to expectations that interest rates will rise faster than previously expected. You kind of just want to say, duh. And again, I respect these folks, but they lost me at constructive. We remain constructive on stocks for the year as a whole. So maybe it's me. Maybe I just don't get it. I just don't know what that means. But I thought I'd share it with you. So when you read things like that, constructive on stocks, and you don't know what it means, it probably means that the person who wrote it doesn't know what it means. And, to be fair, I should probably send them an email and just say, can you explain to me what this means? Maybe I'll do that, but we're pretty busy, so I don't know if I have time. So what's the answer to your issues here with all these conflicting pieces of information you got? Markets are down, bond markets are down. The three pillars, remember, like a three-legged stool. Asset allocation, make sure you've got good components in there. And we do that on a regular basis. We're looking at these. We're doing it right now, and we will certainly do it after we have to rebuild our models again when we shift everything over. Making sure you have good components of your investments. That's asset allocation. Make sure you've got the right pie, the pieces of pie in that pie chart of yours. Principal protection. Make sure you have a piece that's going to earn you something. David McKnight says safe and productive. I like that. Earn you something, 3 to 5%, but is not going to be any on average, right? But it's not going to do any less than zero. That's helpful in times like this. When markets are unsteady, when markets are down significantly, knowing that you have a significant portion, and it has to be significant. BlackRock did a great study that showed a third, right? 33%. I've been using that for many, many years now. And it was just kind of the math that we did, my old partner and I did, that figured out this is what kind of dampened that shock effectively. But BlackRock backed it up, saying that it has a great effect in down markets, and it even helps in modest markets. And that account segmentation, where you've got a game plan for each part of your life and invest accordingly, so that you can help eliminate that worry about where am I getting my money from today, and help eliminate that fear of missing out with, oh my goodness, I want to invest so we make money. And by the way, you have to invest so you make money. You can't just be conservative, because some people are calling for 5% inflation. We're seeing 7% inflation. So that trend really continues. Well, you better earn. Okay. So let's stay optimistic though, but let's be defensive. That's, defensively optimistic, I always say, but we've got to avoid the desire or the thought about timing. Timing is very difficult. Make sure you lay out your foundation. All right, let's talk about financial planning. Any questions before I move on to financial planning? We have one. Walter, speaking of my PhD, I think the appropriate thought is act in haste, repent in leisure. Talk more about that, Walter. I'm going to need some act in haste, repent in leisure. Walter, you're going to have to fill me in personally about that. I'll look that up. Hang on. Don says, you piqued my interest. According to Merriam-Webster, third definition of construct is promoting improvement or development with 4 or 5 question marks. Exactly, right? So I don't know how that applies to the, so is it that they're improving their stock positions or they're building their stock position? I don't know. Give me words that I can understand. Overweight, underweight. We don't know. We don't know is fine. That's fine. Okay, good. Good answers, guys. They're good questions. All right. Now let's talk about financial planning. So I'm going to share my whiteboard here. Just closing my notes. think. No, just close my whiteboard. All right, and we are going to talk about why is life insurance an important part of financial planning. So this is something I've shared with you folks. Oh, just an aside, because it caught my eye. The new tax tables are up on our website, outofourwealth.com. Go to the Ed Slott website. I'll just show you quickly. So I'll drag this down so you can see where this is. You can see I was using it this morning. So if you go to Attleboro Wealth and you go to Slot Corner here, you see my cursor where it lights up. If you scroll down, you'll see now 2022 tax planning. So we've updated the charts. We did a little bit ahead of schedule in anticipation of our transition, but you'll see all these charts as you've seen before. You can download these and you see the new uniform lifetime table from the IRS that has to do with RMDs, required minimum distributions, starting at 72. So I don't want to spend a lot of time on that. Let's go back to our financial planning topic. All right, so I'm going to move things. I'm going to be looking down. So why is financial planning so important? Well, let's lay out a real life situation here. And you're familiar with the buckets, of course. We have taxable, we have tax deferred, and we have tax advantaged or tax free. So taxable, just to kind of go back and remind you, right? A little bit of review. Taxable is these are typical mutual funds, anything that's held outside of a retirement account or some kind of tax sheltered account, even if it's deferred or tax free. So that could be your mutual funds you hold at Vanguard, Schwab, Fidelity, wherever. That aren't in IRAs or 401ks or anything like that. It could be your CDs at your bank. It could be your bank accounts. Anything that is in that you get 1099s on, right? 1099s, not 1099Rs. They come out of here. The 1099s for dividends, you're getting them right now. Dividends, interest, short-term gains, long-term gains. So you get reports on these things, 1099s for them. And all this equals tax on an annual basis, right? Every time you get dividends, every time you get interest, you can't control these things sometimes, short-term gains and long-term gains. Last week, I talked about, I think it was Fidelity or Vanguard, paid out a significant amount of capital gains that many shareholders in their mutual funds were not expecting. So they're what we call embedded gains, and these have to do with mutual funds, and it's very, you can't do anything about it. Sometimes you have to pay tax on gains when your fund's down, as you've heard me say. But anything here that produces a 1099, tax deferred are IRAs, traditional IRAs, 401k, traditional, 403b, etc. Retirement plans, traditional. The promise to pay later. You don't pay tax now, but you pay it later on growth. And tax advantaged or tax free is simple. Anything Roth or some properly structured cash value life insurance. So why is we're going to talk today? We talked last week about Roth. Today we're going to talk about cash value of life insurance. Let's put a green circle around that one. So going back to why life insurance is so important, let's lay out the details here. We had approximately $500,000 for this person in taxable investments. So again, money markets, CDs, not the cash that they need in like everyday checking, but other funds that are invested. In this case, it was all mutual funds, ETFs, and stocks. I think held at Fidelity, but that doesn't matter. And there was $50,000 in just cash. Now, to give you a little more information, this couple needs $80,000 after tax. Their Social Security is about $45,000, and they have real estate income of $10,000, approximately. I'm just giving you round numbers on this group. The issue is that we know that there's a mathematically ideal amount to have in each bucket, right? Each one of these buckets. And we know from our class, if you've been on the class, and if you haven't, join us in March, that we need about 6 months to 1 year, right? Some people say 6 months of expenses. I say it's fine to have 1 year of expenses. I'm a 1 year person. I like to have 1 year of expenses in there available in this taxable bucket. And for these folks, that's about $35,000 to $70,000. And how did I get that? Well, they need 80, 45,000 they have coming in from Social Security, $10,000 in real estate. So even if you adjust up for tax, let's say 50,000 to 100, if you really want to give a nice buffer in there. So they've got a significant amount left over here that is going to be forever taxed. Now, I worry about the $500,000 today, but I worry more about what it could be in the future, because if it's invested and they only earn 6%, well, in 10 years times 10, right, years, at 6%, they would have $895,000. $895,000. And let me come back to that. So you see, you've got growth in there, and along the way, you're paying dividends, you're paying interest, short-term gains, long-term gains, just by growth alone, $895,000. So the problem just continues to compound. And that affects the tax on Social Security. It affects your future tax rates. It affects everything, because don't forget what the goal is, right? Let's write the goal up here. The goal is, of course, to have a successful financial plan, to meet your objectives, to do what you want to do, handle your estate the way you want to handle it, whether you have a specific amount that wants to go out to somebody, or whether it's just whatever's left passes to whomever you decide as efficiently and effectively as possible. But the goal here, when we're talking about tax efficient planning, is zero tax, or as close as we can get, right? Which is tax efficient. So that's the goal. I mean, this is the best thing. And many people, we can get the zero tax. But if you can't get the zero tax, you want to get as close as possible and limit the amount of money that is subject to what's certainly coming in increased taxes. So they have $1.5 million. So we know they have $500,000 that could grow to $895,000. They have $1.5 million in their IRAs. And we determined that they could probably keep $200,000 to $250,000 in this IRA, depending on their rental income situation. So we've got some money to move here. And the way we would handle IRA, overfunded IRAs, is, of course, shifting it over time to what? To the Roth IRA, Roth conversions over. So we're converting money. You can, as we said in the Slott report, you can convert as much or as little as you'd like. Doesn't matter how much money you make. The only question is, how much tax are you willing to pay to get that money over, and what makes mathematical sense? So we convert over a period of time to get that money down. And yes, we also have the growth problem. If they earn 6% every year, then this money is going to, be close to doubling in 10 years as well. So we've got to be aggressive about it, and we push it up to typically the top of the 24% bracket if we have to. Sometimes we go over that, if that makes sense. I know David McKnight has different feelings about that, but in practical sense, we have many clients who the math just makes sense for that. So now let's just say we're successful, and we end up with, by the time we're all done, I don't know what happened there, but by the time we're all done, we transfer this money via conversion from IRA to Roth IRA. And I'm just going to make it easy, everybody, with a little bit of growth. $1.8 million is here. $200,000 to $250,000 is over here. So that's good. We've done everything that we could do to be tax efficient here. The problem is here. Now, can we move any of this money, $500,000, to a Roth IRA? Well, I didn't give you the age, but this person's 62 years old. If he or she is still working, right, because you got to qualify for income, or if their spouse is still working, you can contribute to potentially, if your income's not too high, you could contribute to a Roth IRA as well. And you could do $7,000 for one spouse. And if you're married, $7,000 for the other spouse. and get that over there as well. So that'll help bring it down. But then we still have a considerable amount of money here. This is where life insurance comes into play. If you've got other funds that you need to move over, or if you just have some significant needs for life insurance, this is another potentially tax-free bucket. Now, you've got to think of it as an investment, because the numbers I'm going to tell you are not insignificant. Remember, we're fighting against growth and we're fighting against future taxes. Now, if I said to you, if we took $50,000 a year from mutual fund A and moved it to mutual fund B, you're going to have similar growth, in some cases principal protection, and you're never going to pay tax on that again, as long as you continue to have it structured right. You wouldn't hesitate. And that's kind of the same idea. In this example, I'm going to go expand these a little bit so I can grab the numbers. 32,605. We're looking at 32,605 per year. We call it shifting. You can call it shifting, investing, however you'd like, coming out of this bucket into this bucket. And in one scenario, we did times 10. And in another scenario, we did a larger amount, and that was 46,578 a year times 7. And we're going to talk about what that means. That's it, or, right? Either one of those. And there's pros and cons. But that builds in here over time. And if you qualify for it, right? Qualification can sometimes be difficult, but if you qualify for it and your cost of insurance is low enough, then the cost that comes out of here, you've seen this before, that drips out of here is low enough where the majority of the money stays invested in here and can grow over time. And I like to use indexed universal life. There's a lot of different options. We don't have the time to go through them today. I've gone through them in other webinars, but I like universal life, indexed universal life, because the worst you can do from the investment perspective is 0 in any one given year. And good average is 5.5 to 6.5% that you can earn. You can earn as high as, we've had some that do 16, 17%. But let me just see. Somebody's got a question. Let me make sure. Okay. I want to make sure you can see my board. So we've had some that have done much larger numbers, 10, 16%. It's much larger numbers. But assume, this type of return is probably fair. Well, this money grows in here tax-free. And I'm going to show you little snippets of what we call illustrations. This money grows tax-free, and you end up with a cash value in here that you can take out for your retirement or for whatever you'd like. It's not required. It gives you a lot of flexibility. And in this example, let's just grab it from here. Let's see. I'll come back to that, I promise. So in this example, it's $40,140 a year. And I'll come back and show you the details of that. $40,140 a year. So in that example, this person can, after that sat there for 10 years and grown, they can take out $40,140 a year, and that is a tax-free distribution as long as it's set up right. This policy, as an example, also gives them a $500,000 death benefit right off the bat, year one, as soon as you fund it. As soon as you shift in or invest your first portion of money, you get a $500,000 death benefit. If that goes to your heirs, that's also tax-free. So that's good. It's a great return for them if you pass early, but it's not great for you. And if you qualify, this death benefit, right? That's a death benefit. That can also be used as a long-term care benefit. So if you need long-term care in the future, you can have money to draw from to help with that care. Now, it's not 100% of the $500,000 in typical cases. They discount it. It can be anywhere between 80 to 95+% of that $500,000, but most of them, you don't pay for it. If you want it 100% of the $500,000, come hell or high water for long-term care, you could find a company that offers what's called a long-term care rider and pay 1.5% for it. I don't see the value in that, but sometimes it is. So that's, you can see here multiple buckets to pull from. You can use this for income tax-free. If you need long-term care, you can draw on this death benefit tax-free. If God forbid you pass away, even whether you use this for long-term care or income or not, your heirs get what's left tax-free. So it can work really, really well. And it gives us a vehicle to bring this down where we want it to be, 6 months, 1 year. So it helps really not eliminate the 1099s, but reduce it enough where it's going to be beneficial. Because again, the goal is, we have an amount that's low enough. Remember this, that is less than your standard deduction RMD, that is less than your standard deduction. So you don't pay tax there. Any distributions from your Roth, of course, are zero tax. You got to follow the 5-year rule and all the things that are involved in that, but most people don't have an issue with that. So no tax here, no tax here, minimal tax here. And depending on what's happening with this real estate, you may have a zero tax situation with your Social Security, but at least it's minimizing the tax of that Social Security. So again, that's the goal. But even if you're paying tax on your Social Security and you can't keep anything in your IRA, you'd certainly want to shift everything you can over to this side, right? This side of the ledger, and what exists on this side of the ledger is the Roth and cash value of life insurance. My friend David McKnight calls this a life insurance retirement plan. I got a great book that he wrote if you want a copy of that. But I'm hoping you can see how important this is. It's a shelter against tax. It's an opportunity for income. You don't have to take the income, but you can. You can let it build. I'm going to show you that in a moment. Death benefit for your heirs. So the money, if you need it, can be used for long-term care if you qualify. But if you don't use it, it goes to your heirs to help them out when you're no longer here. It's such a powerful tool. And I'll tell you, I've shared this with you. When I was at UBS, Wells Fargo, I sang the same song everybody sang. Permanent insurance, whole life, universal life, no good, too expensive, blah, blah, blah. Buy term, invest the rest. Completely wrong. Completely wrong. In fact, my 2 term policies are about to expire next year. I just redid all of my insurance, got something exactly like this. I wish I would have done that when I purchased the existing policies when I was 32 years old, right? We can all say that. Wish I would have done it then. But let me give some details here, show you some details of all this string of numbers I just sent you. Here's an example. This is the one example I showed you. I'm going to go back a little bit. This is no income. So I hope you can see these tables. And again, this is just an example with one company. I'm not even going to mention the company because I don't want to get into that. There's several different companies we deal with. But you'll see here, these folks invest $32,000 a year for a period of 10 years. So I don't like it when you pay forever because I want you to know what your costs are going to be and they're manageable for a period of time. I don't just, if it makes sense, you can put more money in, there's some flexibility there, but I like a finite investment amount and this works for them. So let me just see if I can make this, since we're so close, I want to see if I can make this a little tinier. Yeah, that might work. All right. So we invest $326,000. You'll see that there is a cash value. We're going to focus on this number here. This has grown an average of 6.2% to $364,000 in cash. There's a $500,000 death benefit even in the first year. And then you'll see that the death benefit over here starts to go down, right? Why in the heck would the death benefit go down? Well, in this case, they start drawing funds out every year, $40,140. Well, that can come out or not come out. They can stay in there. They can be used for retirement income. Some people use it to buy another property, a second home, a new home, whatever. But what happens is loans are taken off of this cash value, and it has to be structured that way. That gets very complex. Most of the life insurance policies we use are zero. That's a net zero loan, or you can use what's called an arbitrage, where you have an opportunity for growth. Again, gets complicated. Each one's individual, but you can see just fundamentally you start drawing on this cash, and we want to make sure that this is going to be around for a long time. So we stress test this. People often laugh, but look at this. We go all the way out. This actually goes out to 120, but if you live to be 100 years old, you've taken from the policy. Remember, you put in $326,000, which is a lot, but it was invested and you're investing it, right? It was invested over here in Vanguard. As an example, you're investing it over here to achieve the growth, and you're getting still getting a return in there, tax-free, tax sheltered, as long as you follow the rules. If you live to be 100, you've taken that $40,140 every year, $1.2 million you've taken out, and you still have well, in this case, if you died, yeah, either one, $287,000 goes to your heirs, or $335,000. So that's if you're using the income. Now, let me just show you, if we don't use the income and we just say, you know what, and you don't have to decide until you start drawing, and you can decide year to year. Well, look at this. This is the same scenario. $326,000 gets invested from forever taxed and never taxed. Back over here to the $500,000, it's the same thing. $500,000 death benefit in year one. You'll see here that it starts growing here. Do you see that? It starts growing because no money's coming out. Your cash value is growing, so the IRS requires that the death benefit go up. The IRS is savvy to this. They know that people are using this as tax shelters, and they're not going to just let them build up cash value and keep the death benefit, way down here. It has to truly be life insurance. But you'll see here, what are we at, age 81? If you decide hey, listen, I don't need the $41,000. Well, it's not like an IRA where you have to take, traditional IRA where you have to take it. You have flexibility. Now your death benefit is now $800,000. And don't forget, this could also be potentially a long-term care benefit if you need long-term care. So that's beneficial. And if we continue, you'll see at age 90, many of you are going to live to 90. You've still put in that same $326,000. It's now $1.5 million of life insurance that's going to go to your spouse, your kids, or is available if you meet the requirements of long-term care. So people like that. I like the flexibility. I like this level of coverage here because this concerns me quite a bit for everybody, including myself and certainly my clients. So the nice thing about these structures are flexibility. You have the ability, if you wanted to go and take that $40,000 a year, you can, and you, again, flip the switch on and off, or if you wanted to continue to build, you can. That's why I think it's so powerful and so important to tax efficient financial planning for sure. Just one other point, and I'm going to sign off. You can structure it many, many different ways. This is the same amount of money, just over a shorter period of time. In a comparison, you would see that the cash value grows significantly more. You remember that there was about $793 or $793,000 worth of death benefit. This one would be over $890,000, I believe. But remember, with the other strategy, paying it over 10 years, shifting that money, investing over 10 years, we could take out $40,000 because this same $326,000 is invested over 7 years in this example. And because there's more time for that to grow, you can actually take about $5,000 a year more if you wanted to. So there's many ways to skin this, but so important to financial planning. I am always elated when my clients can qualify for these. It just helps. It helps to have another bucket to pull from. I'm going to bring back the scribble here. There we go. Coming back to the beginning. Let's just bring this down. Okay. All right, folks, it's 11 o'clock. I hope you have a great week. We talked about the markets. We went over the Slott reports. I told you when David McKnight is joining us. We have Sarah Brenner coming up as well. We have a class coming up. We reviewed the value of life insurance and financial planning. We talked about our transition. Just please be patient with us. We have, it's a tremendous amount of work, but it's good for you. It's good for us. It's really going to be fantastic. We do have a couple of questions. Let me just see here. So Hank asks, can you take periodic distributions from the life insurance? I'm assuming. Yes. Yeah. There's a certain period of time where it makes sense, usually about 10 years. You can take it sooner if you're funding it, say for 7 years. You can take it in year 8. You just want to look at it each and every year to see what makes the most sense. And we also, I showed you 40,000, 40,000, 40,000. It doesn't have to happen that way. We actually check in with the insurance company each year to make sure that we're not violating any IRS rules, because we don't want it to become taxable. You got to be careful with these things, but we help be careful. Gerard says children or grandchildren should fund it. Yeah, I guess that would be the best for you. But if you still have to do something with that money that's in that taxable bucket, right? But that's another strategy too. So if your children or grandchildren have a lot of money that they don't know what to do with, and they're going to be taxed and they're worried about that, sure, they could fund it. They don't have the same benefits you have about taking it as income and long-term care. They're just solely basing it on the death benefit. And Gerard also asked, how are RMDs taken from qualified annuities? Can they be converted to Roth whole or in part? No. So qualified means IRA. Annuities are treated just like any other retirement account in the regard of RMDs. Sometimes there's a little bit more of a difficult calculation depending on what kind of guarantees they have. But no, RMDs cannot be converted. So in fact, you have to take RMDs first before you do any conversions. So good question, no, Gerard. All right, folks, it's a little over. I hope this was beneficial. We'll see you next week. If you need us for anything, reach out. If you want to schedule time, I think all of February is blocked. If you're a client, though, jump in, call us. We can certainly get you in. We blocked off for these kinds of webinar follow-ups and non-clients while we're working through transition. But clients, please, if you need us, reach out to us. Have a great week, everybody. Take care.